Day trading is the act of buying and selling a financial instrument within the same day, or even multiple times over the course of a day. Taking advantage of small price moves can be a lucrative game if it is played correctly. Yet, it can be dangerous for beginners and anyone else who doesn't adhere to a well thought out strategy. Here, we'll take a look at 10-day trading strategies for beginners. Then, we'll consider when to buy and sell, basic charts and patterns, and how to limit losses. Knowledge is power. In addition to knowledge of day trading procedures, day traders need to keep up with the latest stock market news and events that affect stocks. This can include the Federal Reserve System's interest rate plans, leading indicator announcements, and other economic, business, and financial news. Set aside funds. Assess and commit to the amount of capital you're willing to risk on each trade. Many successful day traders risk less than 1% to 2% of their accounts per trade. If you have a $40,000 trading account and are willing to risk 0.5% of your capital on each trade, your maximum loss per trade is $200. Set aside time. Day trading requires your time and attention. In fact, you'll need to give up most of your day. Don't consider it if you have limited time to spare. Day trading requires a trader to track the markets and spot opportunities that can arise at any time during trading hours. Being aware and moving quickly are key. Start small. As a beginner, focus on a maximum of 1 to 2 stocks during a session. Tracking and finding opportunities is easier with just a few stocks. Avoid penny stocks. You're probably looking for deals and low prices, but stay away from penny stocks. These stocks are often illiquid, and the chances of hitting the jackpot with them are often bleak. Time those trades. Many orders placed by investors and traders begin to execute as soon as the markets open in the morning, which contributes to price volatility. A seasoned player may be able to recognize patterns at the open and time orders to make profits. For beginners, though, it may be better to read the market without making any moves for the first 15 to 20 minutes. Cut losses with limit orders. Decide what type of orders you'll use to enter and exit trades. Will you use market orders or limit orders? A market order is executed at the best price available at the time, with no price guarantee. It's useful when you just want in or out of the market and don't care about getting filled at a specific price. A limit order guarantees price, but not the execution. Be realistic about profits. A strategy doesn't need to succeed all the time to be profitable. Many successful traders may only make profits on 50% to 60% of their trades. However, they make more on their winners than they lose on their losers. Make sure the financial risk on each trade is limited to a specific percentage of your account. Stay cool. There are times when the stock market tests your nerves. As a day trader, you need to learn to keep greed, hope, and fear at bay. Decisions should be governed by logic and not emotion. Stick to the plan. Successful traders have to move fast, but they don't have to think fast. Why? Because they've developed a trading strategy in advance, along with the discipline to stick to it. It is important to follow your formula closely, rather than try to chase profits. Don't let your emotions get the best of you and make you abandon your strategy. Bear in mind a mantra of day traders: plan your trade and trade your plan.